All right, so NASDAQ, this is our daily chart here. Take your attention up to this old high here. So that is a key level, 12,339 even. Then the consequent encroachment of that wick, because wicks are gaps. Some of you are asking, what do I mean by a wick is a gap? The algorithm refers to a wick as a gap. And the gap will want to most likely be treated to its consequent encroachment, which is the midpoint of the gap. Not to be confused with a mean threshold, which is the middle or 50% level of an order block. Okay, so my order block theory and gap theory are distinct. They're very similar in some ways, but they're very different in others. Okay, so as I mentioned, we'll go over more of it as we go through this year in 2023's mentorship. All right, and over here we have two down closed candles, which is the bullish order block. If you look at the candle's high here to this candle's low, that's a buy side imbalance, sell side inefficiency. Fair value gap, but specifically categorized as a BISI, buy side imbalance, sell side inefficiency. The market trades down into it here and trades into the order block, the open to the high. So both of those levels here. Be mindful that this blue shaded area is this imbalance from here to here on this single candle. And the order block are these two heavy blue lines, okay? So it looks like we traded down here, picked up a discount, pulled off the low, and we'll probably look to trade up into this level here, 12,149 even, tomorrow going into Friday. All right, so here we are on the hourly chart, and right away your eye should go right to this clean level here, relative equal lows, and here's that daily buy side imbalance, sell side inefficiency right here, this blue shaded area. But it's aimed at this range from here to here. That's what it's showing. The order block high in the open on the daily chart, that's what these levels are here. So you can see how we ran up, took out the short-term high, broke lower. We have a high, low, higher high. Down closed candle is what? Bearish breaker. Trades below it, comes back up, bumps it, sell off. Does. Sells all the way off to take out the sell side liquidity. And there's an imbalance here and an imbalance in here. And we're going to take a closer look at both of those. Right, here's the 15-minute time frame. You can see the sell side liquidity pool here. Too clean. Jagged edges are the result. Smooth edges like to be made what? Jagged. Okay. Fair value gap here. Market trades down into that. Comes back up. Finds the support. Rallies through the short-term high. Trades up into the imbalance here. And what I'm watching tonight into tomorrow is, do we continuously press higher? It looks like they're trying to give like a 3 dries pattern, 1, 2, 3. I don't trust that. I really don't trust it. I feel like they're going to try to send it higher. I might be wrong, and I'm completely comfortable being wrong, but this feels like they want to send this thing higher. And this high, while it is a nice breaker, it actually has multiple breakers in it. We have the high, the low, the high, and this down closed candle. Project it forward. That's the reaction I showed you before we dropped down from the 60-minute chart to the 15-minute chart here. That was the reaction we saw dropping. But there is another breaker with high, low, higher high, just as well as you can use this here. High, lower, higher than this. The down closed candle, you project that forward. We traded into that. Okay, we went above a little bit here, above this candle's high, right there. So I'm watching to see, do we disrespect this SIBI? Okay, because this actually is a balanced price range. And it needs to get through that. Now, should we get through all of this range in here and trade aggressively above that, then the levels I mentioned on the daily chart are within reason. Otherwise, we could chop around. I don't see a sell-off here yet. Like, I don't expect a big dramatic sell-off because we had pretty much that, overnight on the 24th, which I outlined real time, showing you in the charts. We're actually within under 2 handles from the very high of the daily chart, making this rotation lower. When I was referring to ES, not the NASDAQ, by the way, but nonetheless, it's the same thing. All right, so here's the 15-minute time frame with the imbalance here. So we have sell side and the fair value gap. So it digs down into that, and it's also the low end of what? The sensitive price point of a bullish order block, which is the opening price, and the high. So it trades down into it, hits it, and then reacts. So let's take a closer look inside this area in here. All right, dropping down to a 2-minute chart. Why 2-minute chart? Well, to save time, and this is the chart that has all the details that you would have worked down through anyway. We have buy side here, smooth relative equal highs, smooth relative equal highs, breaks order block, trades back to it here, sells off, trades into our imbalance, digs in to the lower end, which is the, what is that? The opening price on the down close candle on the daily chart, which is bullish order block. This is the high of the daily bullish order block. Okay, so that way, go back through this video a couple times. I promise I won't go too long with it, but this level is the opening price on the daily chart, down candle, at the beginning of the discussion for NASDAQ. We trade down into it, taking out sell side here, and then trades higher, trades back down into a fair value gap after sell side's been taken, and a higher time frame order block has been traded to. The market rallies, trades above a short-term high, so now we have a shift in market structure. Fair value gap here, trades down into consequent encroachment between the candles low and the candles high here. Midpoint is here, and we have a bullish breaker. So we have low, high, lower low, take the body of the candle, most uppermost candle, extend it forward. Okay, you're doing it with the up close candle, not the down close candle when you're using bullish breakers. Extend it through. You can see we're finding some support in here, consequent encroachment, and you want to see gaps like that in this stay open. It would promote the idea that you may be seeing a breakaway gap. Market rallies back up into last up close candle. This would be a breaker by any other definition, but because we are elongated from that high, in other words, it keeps stretching further, when we trade back to it and above it, it's mitigation. Okay, so what's being mitigated here? Any trader that's offside that was going long in here, they can mitigate that trade here. Order blocks and candles are not mitigating. Okay, I see a lot of people using the word a lot, excessively. Mitigation and mitigating is the action of the trader that is offside. Order blocks and candles are not mitigating anything. Price is allowing the trader to mitigate their offside position, mitigating potential drawdown, limiting it or removing it altogether. So that was the function of mitigation. Trades down to it here. Also, we have a buy side imbalance, sell side inefficiency. This candle's high, this candle's low. We dip into that partially. It's supporting. Why didn't it go all the way come down to this level here? Because of the mitigation block. Leaves some of that open. Expect it to be institutional order flow entry drill, which is a partial entry to a fair value gap before resuming higher. The market reaches up into the buy side liquidity here. Creates a bullish order block. Trades down into it here. Rallies, fair value gap, consolidates, accumulates more long positions, and then rallies away. What level is this accumulating longs at? At the high of the daily bullish order block wick. And down here is the daily order block opening price. So this is the high wick area of it. And then we have market rally up, order block retest here, and continues to move higher. Afternoon session on NASDAQ, dropping into still the 2-minute chart. New York lunch begins and ends. Here's that run from the order block, and then the fair value gap rallying around the high of that daily bullish order block, wick high. Rallies, order block, as I mentioned before we transitioned into the PM session slide here. Another institutional order flow entry drill right there. I don't have that noted, I apologize. Fair value gap with an order block, trades into it here, rallies, order block, cut through candles, folks. Bullish order block rallies, another order block, 1, 2, 3. Why do I only use this one candle here, and why do I use all of these here? Because all of these candles here are going against order flow. Order flow is bullish. So if there's a series of down close candles and we rally through it strongly like we do here, go back to that original high candle, extend it forward. We have an imbalance, yes. We have a potential order block here, but I'm not interested in that one. Why? Because the candle's body on this one goes lower than that one. There's rules, there's levels to all this, folks. The market drops into the order block, accumulates, rallies again, small little fair value gap in here between this candle's high and this candle's low, extend it through, accumulates longs here, 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 and then once more over here. Why? Because it needs to go higher. In that last hour trading, the macro runs from 3 o'clock to 4 o'clock, trades down to the order block. Everyone thinks the high's in place, pumps it through, clears out buy side.